All right. Awesome stuff. So really excited to dive in today and start off with a quick intro here. So for those who are not aware of who Carla and I are, we're the co-founders of Cycle CPA. We do remote accounting services specifically for companies in the green industry. And so that's everything from the bookkeeping all the way to tax. And we work with companies throughout the country. And we like to put on webinars like this to help keep people up to speed on important topics, whether it's related to the financial side and business side as well. And super excited to also have a guest here as well. And, someone that we've known for quite a few years here and, have been working closer with. And it's Phil Harwood. He is the founder of Tamarisk Legal Advisors, Tamarisk Business Advisors, and also helps to lead the Snow Fighters Institute. He's an attorney and entrepreneur with over 4 decades of business management and leadership experience. And he brings his real life experience and best practices to better meet his clients' needs. And so he advises business owners in the green and snow industry and their teams on things like business succession planning, valuation, entity formation, business-related legal matters, and much more. So thanks again, Phil, for joining us today.
Yeah, glad to be here.
Awesome stuff. And, I think so today we're going to be going through optimizing your exit, how your financials impact the business valuation, continuity, and succession planning. And one of the less exciting things about when you're looking at maybe an exit or succession in business is starting with the financial side of it. Right. And making sure that everything from some of those foundational components all the way to how your numbers are analyzed and how you're more looking forward and doing some of the forecasting, how that all kind of plays into this process.
And, this 3-step approach brings more of a holistic approach of managing your financials, right? We don't want to, I think having your accounting and bookkeeping done on a monthly basis or weekly or quarterly cadence is good, right? That's a great starting point for anybody starting a business or looking to, further their business and getting to a goal where, eventually they do exit. But we also want to take time to review those numbers and looking at the accuracy of your financials and having that open conversation with your accountant. And after you review, looking at the different KPIs, metrics that help drive your business forward. And then budgeting and forecasting ties all of that in because it's not looking at historical information, more looking at future facing information and what is your goal in the next few years of the business. And you can really build those goals into your budgeting and forecasting. So it's a more holistic approach that we advise people to take.
Yeah, and before Phil dives into a lot of the specifics in regards to valuations and succession planning and how that's going to be, something that you really want to optimize, in these first 5 to 10 minutes, we're going to touch on some of these main components. Of course, starting with that foundation. So looking at all the bookkeeping and accounting that's being done within your business. And it's key to, in all aspects of your business, to try to leverage technology as much as you can. A lot of times looking at different software that can be utilized. Many of our clients are on softwares like QuickBooks Online, right? Can we use something like Bill.com to help with accounts payable or Gusto for payroll? So the more you can leverage this technology, the better you're going to look to any potential buyer. And these kind of things is, it's what's going to build that credibility and, confidence, especially in those initial stages within the due diligence and as those buyers are really, really looking into your books. Because ultimately, you want to be in a position where you can provide this info relatively quickly and as accurate as possible. Because the more that this process is delayed, the more it just opens up time for different uncertainties to come up and other delays that can happen within some sort of exit or succession process. In worst case scenario, it's even, the buyer leveraging some of that uncertainty to even come back with certain discounts in regard to valuations. So, and you want to also put yourself in a position where you can really portray that confidence and, being that you have these sort of management practices and that level of sophistication, right? That's the impression that you want to give.
Yeah, and QuickBooks Online, being what most green industry and snow industry companies use, is really making strides within the AI space and building that AI layer within the accounting software itself, where it's going to save your accounting staff a lot of time. Even it could be even hours of time doing the manual accounting work. If you're using something like Bill for accounts payable, receivable, they also have an AI layer built in there that is also going to save time for your accounting staff and Gusto as well. So I think that with the time savings that we're seeing is, okay, yes, we have these salaries or these people, but also now that time could be better utilized for future planning and looking over your books diligently and making sure that everything is caught up and all your T's are crossed and your I's are dotted, because now it's going to open up that capacity.
Yeah, and ultimately, you're going to be the one that will hopefully benefit from those efficiencies that are gained as you're implementing certain things. So as you're looking at your financials, and more from an analysis perspective, you can look at things like, okay, this is what our administrative budget is. As we implement software, you're going to get that ROI based on that. You don't want the buyer to find out things like that. You don't want the buyer to be the only one that, once the business is sold to them, now they're able to make some quick wins just based off things that they can quickly implement and see, right? So that's why having that financial review is important. Making sure that you're analyzing numbers year to date based on previous years, even based on certain initiatives that you're looking to implement within the business and seeing what the ROI is based on that. So that's a big thing. You want to be able to sell your business at a premium. You don't want to sell at a discount and have someone else reap a lot of the benefits because you didn't implement some of these things.
Right.
So, and you also want to be in a position where you can explain the why behind the financials. Why, if there's a certain seasonality to it, even as you can see below, can you explain why your margins have changed? Which service lines drive profitability? Which customers create the most value, right? So the more you can dive into that, similar to maybe saving on the administrative side of the company and saving on costs, if you can look ahead and have that data in regard to what customers are the most value, you can make those changes. And increase profitability. And then looking at things like budgeting and forecasting, right? So ultimately also making sure that, during a potential exit and succession planning, a lot of your time is going to be spent on that, and you don't want to be too distracted, right? So especially during that time, making sure that there is no decline in sales, right? And making sure that you're sticking to that budget and understanding, okay, what is that sales figure supposed to look like, but also from a cash flow perspective, making sure that you're in a good position from a working capital standpoint and cash that you have available in the business. So it's really just carrying a lot of those business fundamentals forward as you look to ultimately build up to that and, really optimize that exit as much as you can.
It's important in the time of budgeting and forecasting for your company is that you have, your salary built in there with whatever increase or distributions that you may have. That's an important figure to know. And for yourself, even if selling is a few years down the road, I think this is something that buyers are looking to know, okay, what is the role that you have in the company? How much are you paying yourself? What is the task list? How many hours do you work? And so having a start in a plan for that, and then eventually seeing, okay, what do I want that to look like down the road, not only for yourself in personal life and just managing the business better, but also if you are planning to exit in a few years. I think that's a great starting point.
Absolutely. And as we mentioned, you know, a lot of this stuff is the foundation, and you can really, it can get fun, you know, as you can see how you can improve the business in certain ways and really build up to that point, and, you know, hopefully have, you know, months and even years where you can think about a lot of this stuff and really plan for the future. But a lot of what this, you know, really kind of goes up until is, you know, that actual exit, and even when you're considering certain valuations. So would like to hand it off to Phil here, where he's going to dive into the rest of the presentation.
Thank you, Phil.
Yeah, thank you, Carla and Joe. What you just shared is so important. It's so critical, not only for exiting your business, but just for profitability and sustainability. Doing those monthly financial reviews and identifying specific areas to improve on in the business really set up a much better business to be an owner of, honestly. And, you know, of course, more profitable businesses are just more fun to own because we have more resources to work with, and we can have more generous benefits, and we can have nicer toys, and we can pay our people more, and all those things are really good. So I'm a huge proponent, and always have been, of, you know, really deep, you know, consistent monthly reviews, budget updates, and really diving into your financials is so critical. So yeah, I just wanted to mention that. I thought it'd be really good just to take a quick second and give a little bit of background here, because, you know, when people hear of a consultant coming in the room to talk about something, people are like, oh, who is this guy, you know? So I just thought it'd be helpful for everyone to, if we haven't met, I know some of you, we've known each other for years and years, looking at who's in the room here. But, you know, I started my career in the landscape industry in 1985, and we do some quick mental math, that's 41 years ago. So, you know, 4 decades in the landscape industry. I spent about 10 years working in a retail garden center environment. So I worked in store operations, I was a district manager, then I moved into the corporate office. This was a pretty large company, had about 400 locations throughout the eastern part of the US. So that was kind of like chapter 1 of my career, about 10 years. I spent the next 15 years in the landscape contracting world, the world that many of you are in. So in the Detroit market, in Michigan, huge market, a lot of money in Detroit with the auto industry and all the auto execs and everything. I was the co-founder of a business there that's still thriving. I left that business 18 years ago to start a consulting firm. And I've been self-employed as a consultant, and I've had several employees over the years with me, and my consulting business has really been focused on growth, a lot of EOS type work that I've been doing. But really my consulting over the years, more recently, over the last, I would say 10 years, has really started to focus on succession planning. And then, you know, several years ago, we just made the decision to go full throttle on succession planning. So that's really where we're at right now, and we'll talk more. That's really the premise of our webinar today. So I've been doing that for about 18 years. And then along the way, I decided to go to law school. And so I picked up a law degree, and, you know, for funsies, because what else are you going to do in your spare time to go to law school?
Sounds like a lot of fun.
I own a law firm, and we do business law, and we do business brokering. So we do M&A type work. And here in Michigan, we do some more local things like, you know, estate planning and things like that. But nationally, we're doing really M&A business law work. So a little bit about me. So I just want to keep rolling here into our agenda. I have a lot to cover in a short amount of time. So the first thing I want to talk about here is the big change that's been happening really our whole lifetimes. We've seen this coming, this big demographic change. I love this phrase, the silver tsunami, this big wave that's coming at us. And really what it is, it's the big baby boomer generation that we've heard about our whole lives. Well, they're retiring. They started retiring a while ago. So officially, the baby boomer generation defines people that were born between 1946, so like right after World War II. So you think about this massive world war that ended, and immediately everyone reconnects and starts having babies, and the economy does well all throughout the 40s, 50s, into the early 60s. So people born from 1946 to 1964. So right now, today, these baby boomers are from 62 years old to 80 years old officially. So that's the demographic, this big, massive, bubble that we've been talking about our whole lives. Well, think about that. If the youngest part of the baby boomer generation is 62 right now, in 3 years, they're going to be 65. That means all baby boomers are going to be 65 years old or older. So, and then what happened after the baby boomer generation, and it still continues today, is there's been a steady decline in birth rates. So we had this huge bubble. Now we have this declining birth rate. So as a percentage, our population is getting older and older and older. And there's not enough younger people to backfill. So that gets into all kinds of labor issues and employment issues. And we see this, right? We see this when we go around. Everyone's shorthanded. You see it in your own businesses. Where are all the people? Well, they're all old. So, good luck trying to get an 80-year-old to do landscaping. But, that's kind of where we're at today. And it's not just in the U.S. It's every country. This is a global, this same thing that's happening in the U.S. is happening all around the world. So, along with that, and this really gets into the heart of what this silver tsunami is, there's going to be this huge transfer of wealth, right? As the baby boomers move on, pass along, they're gonna transfer their wealth to their children. And so there are some estimates that the wealth transfer from baby boomers to the next gen is over 14 trillion over the next 10 years. And a lot of this is coming from estates, but a lot of it is also coming from business owners who are exiting their businesses. And so specifically thinking about the business side of things, there's kind of a crisis looming here. I've seen this 80, 90, 19%. I've seen all kinds of data points that are 80-20 type things like this. So basically what this is saying is 80% of all business owners today expect to exit their business in the next 10 years. A lot of these are baby boomers. And of course, they want to exit. They want to do other things, or they're having health issues and they want to travel and they have grandkids. But only about 20% of them actually have a plan. So there's this huge gap, right? And the reality is that, every business owner will exit, right? They will exit their business somehow. So it's a question of when and are they going to be prepared to do so. So I want to look at a couple different exit scenarios and just kind of talk our way through it. And there's many different variations, and there's lots of different ways business owners could exit their businesses. But I'm just going to kind of roll through 3 of them here, just because these are fairly common, and it'll provide some insight into where I want to go with this talk today. So the first one is where we have a partnership and one of the partners exits the business, okay? And that's a very unique situation where we have a partner and one of, the whole business isn't being sold, but one partner is exiting and the other partners are staying in the business. Very common, but very different than number 2, where, the owner, or typically the founder, is passing on the business to a child, right? First gen to second gen, sometimes second to third. Very few businesses make it past third generation. Some do, but very few do. In the third scenario here, I want to kind of chew on is where the owner exits suddenly and they didn't have a plan, which is obviously is worst case scenario. So let's take a look at that first one. And this is our partnership scenario here. So you know, there's a saying I've heard many times that goes something like this, like, you know, there's never a problem in a partnership until there's a problem. And so, you know, kind of what's implied in that statement is eventually there's going to be a problem. Not always, but usually there's a parting of the ways. So it's really kind of best practice to think about how that partnership is going to dissolve or how people can leave the partnership at the very beginning. It's one of the very first things people should do when they are starting to form a business. But very few people do that because that's the last thing you want to talk about with your partners when you're starting a business. You're investing money, you're trying to figure out your business model, you're scrambling to buy things and hire people and get clients and perform work. The last thing you want to take time out and worry about is, oh, what happens someday down the road, 20 years from now, when one of you wants to leave. But that's the best time to really address this. So sometimes when someone leaves a partnership, it's a very beautiful thing, right? Somebody has a vision for something else. They go to their partners and they have a conversation and they, over time, exit the business. And it's just this peaceful, amicable, friendly thing. There's hugs, there's kisses, there's parties. And I've been part of some of those and they're really cool. You know, it's like, don't burn a bridge on steroids, right? Exit the right way, no regrets. That's the amicable exit. Unfortunately, a lot of times when a partner exits, it's not that way. It's the opposite of that. There's confrontation, there's cold shoulders, there's maybe hostility, and there's unresolved issues. And a lot of times we end up in litigation, and certainly relationships get strained. And these aren't just, you know, inconsequential relationships. These are familial relationships. These are family. Sometimes these are, even if it's not family, it feels like family. You're joined at the hip to someone in business for 5 years, 10 years, 15, 20 years. That's family. And now that relationship is severed and maybe forever, and it's really sad. So, you know, there's a lot of things we can do to get out ahead of this. And that's what I was just talking about. So one of the things that we can do is make sure that we have a really good operating agreement. Okay, an operating agreement isn't a document that tells you how to operate your business. It's really a partnership agreement. So just the terminology there can be a little deceiving, but think of an operating agreement as the partnership agreement. It defines the relationship that you have with your partners. And it's really essential to have a really good operating agreement in place at the very beginning of your business formation. And if you've been in business for a while and you don't have one, this is a really important thing for you to stop what you're doing and get this thing in place, because you certainly don't want to go without and then have some issue down the road and you're trying to figure out how to deal with the issue and there's no agreement in place and now we're in trouble. Okay. And the problem here with these operating agreements is that most of the time they're not required. You know, here in Michigan, and I think most states, you can form an LLC or an S Corp and not have an operating agreement. Okay. You could have a one-page Mickey Mouse set of articles of incorporation that really says nothing. That's not what I'm talking about here. I'm talking about a very thorough, well thought out operating agreement that defines the partnership, the relationship. What happens when someone has to exit the business? How will the other partners buy them out? What's the formulation? What's the methodology? All those types of things. When we have to make decisions, what's the voting look like? Who has what votes, right? And there's kind of two big categories of decisions that have to be made in business. We have ordinary, ongoing type decisions, managerial type decisions, and then we have these non-ordinary, extraordinary type things that come up that are outside of the normal scope of your day-to-day operations. Well, those are two different scenarios where we want to have different types of voting rights in our agreement. But again, if we don't have an agreement, we're just setting ourselves up to have unmet expectations. A big part of this, an important part of this operating agreement is the buy-sell agreement. But I have that listed separately in the slide because the buy-sell agreement sometimes resides outside of the operating agreement. There might be other people that have a business need to have eyes on the operating agreement, and we don't want them to be privy to the buy-sell agreement details. So we take that buy-sell out of the operating agreement. Nevertheless, that buy-sell is really important, whether it's a standalone document or incorporated into the operating agreement. So that's just a few things to think about with partnerships here. When we are thinking about exiting a business with a generational transfer, one of the really important things to think about is how prepared that next generation is. And one of the really important best practices here that a lot of people miss, maybe they're just not aware of it, or they don't have the stomach to force it. But it's really good to take that next gen person before you start talking about succession and really kind of kick them out of the nest, have them go work somewhere else for maybe 5 years, and then come back to the business, maybe even interview to come back to the business in the right role with that outside experience, because then they have that real life. They're not working for mom and dad. They're not working for their uncle or gramps. They're working in the real world, right? Like pay your own rent, pay for your own car payment, pay for your own cell phone bill, like grow up, right? And so sometimes these generational transfers don't go well because the next gen has never had to live as an adult and grow up because they were always coddled and spoon fed. And so kick them out of the nest, have them go get some outside experience, several years, come back to the business. They're going to be much more prepared to take over the business if they're the right person to do it in the first place. Okay. Second big bullet point here is to have a transition plan that lasts over time, several years prior to the transition, where the senior generation is slowly letting out the rope, giving more responsibility to the next gen, quarter by quarter, year by year, giving them more authority, more control. The senior generation hasn't left. They're still there. They're able to coach, guide, mentor. They haven't left yet, okay? And this is really the optimal situation. And we want to do this while there's still time, before there's a crisis, or before someone gets too old, or they run out of steam, or they get sick, or whatever. Like, we want to get out ahead of this, right? And then the third thing I want to talk about here is this advisor support, because often the senior generation, the parent or grandparent or whoever this is not the best coach or guide or mentor. Sometimes they're the worst one to be in that role. So we need outside advisors to kind of come alongside those junior people, the next gen, and kind of help them develop appropriately and gain those skills and assess where they're at and be the eyes and the ears for the senior generation. So there's just a few thoughts. We've got to move on, but a few thoughts about generational handoffs there. And then we have to talk about the crisis scenario. This is where there has been no planning. We just have something horrible happen. The 5 Ds, you've probably heard this before, death, disability, divorce, disagreement, distress. So these are just different bad things that happen in businesses where it creates an emergency and everyone has to drop what they're doing and deal with this. So there's extreme distress happening, and it's really at the worst possible time. You think about the absolute worst situation where, unexpected death of a fairly young person who was in great health, and, they're there yesterday and today they're not there. I mean, just think what the family's going through, but then think about what the business is how that business is going to be able to survive. Think about the customers, think about the employees, think about the vendors, all the financials. Like, do they have an estate plan? Probably not, if they didn't do any succession planning. So we have this huge mess to clean up. And unfortunately, that's going to be the legacy this person leaves behind, is that the people that they have talked about, that they love the most cherished people in their lives, that they have claimed to be the most cherished people in their lives, they didn't take any steps to protect them. And now those same people are left holding the bag, and they got to clean up the mess. And that's the legacy. So we absolutely 100% don't want to end up in this position, and that's why we have to do some advanced planning here. All right. We got to talk about something nicer now, something a little bit more positive. And I want to talk about business valuations. And there's this world of business valuation can get really technical. There can be a ton of jargon. And I want to try to keep it simple and understandable. So we're going to kind of walk through how to approach business valuation in a couple different ways. And then we're going to look at some examples. Okay. So when we think of business valuation, a lot of times we just think of a number, right? My business is worth X. Well, it's more than just a number, because when we value a business, and we do this a lot now, I do this a lot in my consulting work, and it's really the starting point for us, actually, because of where I'm going here in the second bullet point, the valuation process opens the door to understanding what's driving valuation. So it's the way of seeing into the organization, not only just the financial side, which is huge. That was everything that Carla and Joe were just talking about, but all the non-financial stuff that's going on, the owner dependence and the culture and all the other things that are happening in the organization. We get eyes on all that. We can assess all that. And those are all drivers of valuation. The business valuation is way more holistic than just financial performance. So once we have that insight, we've looked at all those different drivers, well, then we can help that owner create a roadmap to shore up those areas and take intentional steps to deal with those risk areas so their business is way more viable to be sold. Most businesses will never sell. Well, and most owners think they're going to sell their business someday, and they can't. They won't, because their business was never positioned. It's not attractive to a buyer. So we typically have a lot of work to do here. It's not insurmountable, but this isn't work you can do overnight. This takes time. So the very first thing we do when we engage with someone is we do evaluation. Again, not because it gives us a number. It's not about the number. It's about what's driving that number. Why is the valuation what it is? And what can we learn from that? And what changes can we make in the business? And then what's cool is to see that valuation increase year by year as we're working with these clients and improving their business model and reducing owner dependence, which is a huge driver. Okay. All right, I got a lot more information to share, so let's keep going. I want to talk through a couple different business valuation methods, and then I want to talk about minority discounts. So there's lots of different methodologies to value businesses, and if you ever had a business valuation done, if it was a formal business valuation, you probably got a huge 20, 30-page report with all these different criteria and things, and it can be overwhelming to read through all that stuff. I'm not going to do that to you right now. I'm going to try to keep this very high level and understandable. So let's start with the earnings multiplier method, which is probably the most common methodology for valuing a business today. So we start with our adjusted EBITDA, and I'll explain what that means in a minute. And we multiply that times a multiplier, and I'll explain what the multiple probably looks like here in a minute. And that gives us our valuation. So there's really two factors here, the adjusted EBITDA and then the multiple, and that gives us our valuation. Okay. And here in my example, we don't know what this is yet. What does this mean? And what how do we get these numbers, right? So we have question marks here. Well, let's start with EBITDA. Okay. EBITDA means earnings before interest, taxes, depreciation, and amortization. So here's my example. We have a net profit. So this is our earnings. And I know in QuickBooks, earnings is revenue. Don't let me lose it here. Earnings is net profit when we're talking about EBITDA. So net profit in my example here, $1 million of net profit plus interest expense. My example, I have 1,000 plus tax expense. My example is 10,000 plus our depreciation expense. My example here is 100,000 plus amortization expense. My example is 0, because most businesses in the landscape industry have 0 amortization. If we add it all up, we have a total EBIT of $1,111,000. Okay. So let's talk about what these are. So I told you earnings are net profit. Interest expense is interest expense. It's interest that we've paid out. Okay. It's not interest we've earned on our investment portfolio. It's interest that we've paid. It's the expense. Okay. And tax expenses are the taxes that we've paid, not personal taxes, but business taxes. Depreciation expense is the expense that you've taken for depreciation. Amortization expense is similar to depreciation, but it's for non-hard, so intangible assets. So like goodwill, or if you had a patent that had a value to it, that's an intangible asset. Like I said, most people in our industry don't have any amortization expense. And so these numbers, where are we going to get these numbers from? Well, if we're working with Cycle CPA and we have really clean numbers because we've been doing our monthly financial reports and we've been keeping things clean, we can just go to our P&L and pull these numbers really cleanly and get them. But if you think about that process, okay, open up QuickBooks, run your reports, grab these numbers. We're looking backward, right? We're looking back over the past 6 months of this year, last year, the year before. Maybe we're looking back 5 years, okay? But so just think about that. It's all backward looking. And then what numbers are we going to use? What if the numbers varied substantially from year to year? What if year 5 years ago was like the very best year of all, and then it went downhill from there? Are we just going to average everything out? And so that's where some of these details become extremely relevant to the buyer. But when we're just trying to do a valuation, we have to make decisions about how we're going to grab financial information. Are we going back 3 years? Are we going to forecast into the future? Are we averaging? Are we using weighted averages? So there's a lot more details here. Again, I'm trying to keep this high level so we can understand it. But in this EBITDA, just if you step back and think about what this is a way of getting a number that is a comparable number. So if I'm a buyer and I'm looking at company A and company B and company A, B, and C, 3 different companies, and I'm trying to, apples to apples, I'm trying to compare these companies. If I just look at net profit, I can't compare them. If I just look at gross profit, I can't compare them. If I just look at revenue, those aren't apples to apples because there's too much noise in there. The EBITDA is a way of getting a comparable number between companies, apples to apples comparison. Okay, it takes out a lot of choices. So that's what our EBITDA is. We have to then adjust the EBITDA, and we need to add in our owner's benefit. So let me tell you what that is here. Owner's benefit is anything that the current owner is benefiting from in the business, the seller, but the buyer isn't going to pay for. So let me show you an example here. So let's say we have a bunch of officer salaries here. We have Mary, Joe, Elizabeth, Zechariah, and John. Okay. Well, you can see their current salaries here, and but the buyer is going to adjust these. So they're going to normalize these salaries. And so, for example, Mary here, she's a grinder. She works, 80 hours a week. She's indispensable. She's a co-owner, but her salary is only $75,000. Well, Mary's not going to stay with the business. She's an owner. Okay. She's going away. So the buyer is going to have to replace Mary. And the buyer says, hey, in my market, I'm going to have to spend $150K for Mary, not 75. Well, I'm going to normalize that. Okay. So some of these expenses are going to go up. Some are going to go down. And these other expenses here, Mary and Joe's boat, they're spending $30,000 a year on their boat maintenance, legitimately, okay? But the buyer isn't going to pay for their boat, okay? So that goes, all these go to zero. So this is called normalization. So we do all this normalizing and we get all these adjustments. We have a total owner's benefit of $101,000, $101,400, okay? That's the owner's benefit of the current owners that the buyer then could be able to say, well, that's going to go to me. I'm going to get that benefit. Okay, so we need to add that to our EBITDA. Okay, so our EBITDA was up here. We're adding the owner's benefit. Now we have a total adjusted EBITDA of 1.212400. All right, so we have this top number. Now we have to get the multiple. Where do we get the multiple? Well, the multiple can be really tricky and can be negotiated, okay? But it typically is driven by enterprise size. So like smaller businesses have smaller multiples, larger businesses have larger multiples. It's also driven by the industry classification code, this NAICS code. And a lot of valuation programs will rely on that code to give a good range for what common multiples are for these industries. But then there's also all these non-financial factors, like I talked about owner dependence, having clean financials, even your culture and things like that, that affect, and they'll affect that multiplier. And then of course, market demand has a huge impact on the multiple. So let's say we've agreed, we're the sellers, we have a buyer who's agreed to a multiple of 3. We have an adjusted EBITDA of 1.2. Well, then our valuation is 3.6, okay? But just think if we could get a multiple of 4, what would that look like? Right now we're at 3.6. If we went from 3 to 4, we're up to 4.8 million for our valuation. What if we could get 5? Now we're up to 6. That's kind of juicy. What if we could get 10? And it's not uncommon to get a multiple of 10. But we got to play the right cards. What if we could get 10 at 12 million? That's a big step up from where we were, right? 3.6. Okay, so this is kind of fun to look at the numbers, but there's a lot of work to get there. Okay. The other valuation methodology that you're going to run into probably, certainly in the more thorough valuation processes, you're going to see this discounted cash flow method. This is more forward looking. We're looking at future cash flows and we're discounting them back because of inflation. We're adjusting the dollars back to today. It's a pretty complex formula. Good luck with that. This is kind of Wall Street type stuff. Typically in our industry, people are using the earnings multiplier method, that first method, and that's why I went through that more kind of systematically. The other thing I want to talk about here regarding valuations is minority discounts. So, a majority partner is someone who owns more than 50% of the business. They're the majority. They have a controlling interest in the business. They have better voting rights typically. And that controlling interest is generally marketable, which means it could be sold. Like there's probably a buyer out there that would be interested in buying a controlling, share of a business, right? But if we're a minority partner and we own less than 50% of the business, well, we don't have that same level of control. So we're lacking control. We're lacking marketability. It's going to be much harder, if maybe impossible, to sell a minority interest in a landscape business. Who would want to buy that, right? So that value, so if you had the overall value of the business, but you only own 30% of it, your share is going to get discounted heavily. Ranges from 20 to 40% are common. So your discounted percentage of the business of what you really own from that valuation is going to get discounted. All the benefit is going to go back to the minority partners. So keep an eye out for that. Early in my career, I had an 8% ownership stake in a very large landscape business. And I exited at a good time, and I was treated extremely fairly on the way out. There was no discounting, but if I would have exited at a different point in time, that valuation for my 8% ownership share would have been much less. So just be aware. Okay, let's talk about some different types of buyers here. So there are different types of buyers that are going to come along, and it's kind of helpful to kind of know who's who out there. First, so here's the list that I'm going to go through here. Strategic buyers, financial buyers, individual buyers, and industry buyers. So starting with the strategic buyer. So this is a company, typically a company, it's not an individual. They're looking for synergy. Okay, they want to find a company that fits into their existing operations and grows their existing operations, advances them, right? It doesn't have to be from the same industry, but it often is. But let's think of an example where it's not from the same industry. So here's my example. I have this home maintenance company. They do HVAC type stuff for homeowners. They do electrical, they do plumbing, and they're thinking, well, what else can we add on? So let's go find a painting business, or maybe a roofing business, or a siding business, or something like that, right? And so, it's something complementary to their existing business model. So that would be an example of a strategic buyer. What's nice about a strategic buyer is, they're really thinking about the future. They're thinking, man, what if we could buy your company and add it onto my company? Just think of what we could do. So they're forward thinking. They're going to be more inclined to think about future profit, future growth, future cash flow. And there's more of an unknown there versus just valuing your business based on the last 3 years of financial performance and calling it a day, right? So it's a different mindset. So sometimes it's really good to seek out a strategic buyer, and sometimes you can find a strategic buyer who's not even looking. You approach, someone like me approaches a strategic buyer on your behalf, and we sell it. We sell the fit, and it opens up a great conversation to move forward. Another type of buyer that's very common right now in our industry, probably the most common that we hear about every day, is the financial buyer. So these are buyers who are looking for purely financial returns. These are investors or platform companies, and they're not looking to integrate companies into their own operation. They're just looking to make a profit. They want to acquire a business, do something with that business to improve its financial performance, and then sell it 5 years down the line, or 3 years, or 10 years, or whatever. Okay, it's all purely financial. It's a spreadsheet play. And so this is what's happening with private equity, right? These are financial buyers. They're acquiring a target. They want to improve the performance of the target company or a platform. You'll hear the word platform. So like private equity companies will have a landscape platform. So they'll buy a whole bunch of landscape companies and they'll mush them all together in this landscape platform. And it's all about financial performance, right? And it works great. I'm not saying it's a bad thing at all. It's a beautiful thing, but it's a financial investment play, right? Which is very different than the strategic buyer. The next type of buyer is someone that we run into quite often, actually, where it's an individual buyer. So this is not a company. This is a person, one person, or a married couple sometimes, or a small group, maybe friends or something. And like, you know what? We're so sick of working in the corporate rat race. We want to just buy a landscape company and hunker down in our hometown. That looks like a lot of fun. Of course, they have no idea what it takes to run a landscape business, but that's beside the point. But these are individual buyers who want to actually run the company. They want to acquire the company. They want to own it. They want to run it. They want to be in the weeds there every day, rolling up the sleeves, doing the thing. Okay. The fourth type of buyer is what we call an industry buyer. So this is actually very similar. It's a subset of the strategic buyer, but this is someone in the same industry. Okay, and there's kind of two different examples of a industry buyer. One is a horizontal buyer. So the example here is a landscape company who buys another landscape company. Okay, just add the two operations together, make a bigger company. Okay, that's a kind of horizontal growth. The other example is more vertical in nature. And this is where a landscape company maybe buys a wholesale nursery. Okay, so they're buying a supplier business. Okay, so instead of buying plants from the nursery, they buy the nursery. Okay, we see this sometimes with, like, in the snow and ice world. Someone starts selling salt in their market, they become a salt broker. Okay, that's vertical integration. So this is going to function exactly the same as the strategic buyer, but it's just very more focused on your industry, the landscape industry for us. And the last topic I have before we wrap up here, I just want to talk about a methodology that I'm really passionate about. This is the methodology that we use in our business, and it's called the Tamarisk method. And there's really kind of two components of this, but essentially what the succession planning methodology here is attempting to do is, and if someone works with us, is the owner, we're working on owner dependency. Okay, so that business is much more easily transferred, whether it's generationally or to be sold. And there's kind of two different processes here involved. The first one we call clarity. Clarity is just about helping the owner really understand their business and get past all the assumptions, all the things they tell themselves about the business that maybe aren't true, helping them realize, no, this really is true. This is really what it is. Okay, so we're really getting clear about what the owner's relationship is with their business, and clearing away all the smoke and all the mirrors and all the lies and all the stuff you tell yourself in your head, and really helping them get really 100% clear about what they have. Okay, that's step one. Then we move into what we call foundation. And this is where we really start to work on the business with the owner. So creating different structures, making changes, helping that business owner extract themselves from the business so the business can really function without them. That's the goal, because that's a much more desirable business, is a business that where the owner it doesn't have to be involved, right? That's a business that can be transferred to children, grandchildren, or put on the market and be sold. Okay, with that, I think I wrapped up with a couple minutes here for questions, and we will take some questions if there are any.
Thank you, Phil. That was great stuff, and it looks like we do have one question from Benji. Do you just average that last 3 to 5 years, or do you weigh the current year?
It really, it's all over the place. There's no real best practice there. A buyer is going to have their own methodology. Buyer's probably going to want to rely mostly on more current results. So they're going to weight the most recent result. So they're going to look way more intently at what's happening this year. Mm-hmm. So we're recording this today on June 17th. So I'm going to look, if I'm looking at a business, trying to value a business, I'm going to look at, hey, what does that business look like from January 1 until June 17th? What are you forecasting for the rest of June to wrap up June? What are you forecasting for July? That's where that budget comes into play. If you could show me a really clean rolling budget, like, oh yeah, we got the whole rest of the year re-forecasted. Here's what we're going to finish out at. And then, I'm going to look at that first. And then I'm going to start looking backward. What did 2025 look like? Then I'm going to go to 2024. So there's definitely going to be a weighting to it in my mind. But I think a lot of sellers may, especially if they had some really good years that were 2 or 3 years ago, they're going to want to average. So yeah. I think it depends on kind of how you're trying to position yourself here with your valuation. There is some gamesmanship with the evaluation process. Let's be honest. It's like, people say that you can make any statistic say whatever you want it to say. I don't want to say valuations that way, but there's definitely some nuancing that can occur.
Yeah. And it's interesting what the buyer versus the seller really wants to maybe drive home too. Maybe their different perspectives and what
well, yeah, like I said, that strategic buyer might not even care what last year looked like. They're gonna want to do some reforecasting based on what it would look like to take your company and merge it with my company.
Yeah.
What your company did last year is kind of irrelevant.
Yeah. All right. It looks like Bennett has a question. So, a question for Phil: Can you comment on different payouts for owners? Phased, lump sum, based on performance, if they stay on?
Yeah, sure. Yeah, a lot of owners want to just have a cash deal where they can close and walk away.
Mhm.
That's optimal for most owners. Some owners actually want to stay involved, so they're open to staying on in a management role, even if there is an all-cash deal. Buyers, on the other hand, would rather not have an all-cash deal. They would rather pay out over time. So they would want the seller to carry a note. So seller financing is what you're going to hear as a phrase.
Mhm.
And then another kind of twist on that is what's called an earnout. And I don't want to get too much in the weeds here, but an earnout is where the seller is selling the business for X, but they could get X plus Y if they stayed on for 5 years or 10 years and the business performed well and hit all these numbers. So there's usually some kind of benchmarks that have to be achieved to earn the earnout. So, it's kind of I don't want to say this is black and white because it's not, but it could be in your mind. Just say, essentially, whatever's good for the buyer usually isn't good for the seller. When you're talking about like how to structure this, they have opposite goals normally. And that sounds bad, but it's not bad. It's just they have different motivations, right? The seller wants to sell the business to walk away. The buyer wants the owner involved and probably doesn't want to pay for the business all at once.
Wow.
Sometimes they can't pay for it all at once. So then are we going to the bank? Are we getting investors involved? Or are we just convincing the seller to finance the deal over a period of time? So there's no right or wrong answer. There's no ideal. It's whatever the parties can agree to. That if the parties can agree to something they both love, well, then that's a home run.
Yeah. Yeah. Bruce has a question. Will a business focused on residential be less valuable than a business focused on commercial?
No, not at all. In fact, residential work, typically, generally, broad stroke is really kind of evergreen type work where there's not long-term contracts, there's not this big RFP process.
Mm-hmm.
As long as someone's in the house, they're going to continue to have you I live in a home and I have a landscape contractor because I'm traveling quite a bit who does, my landscape work and my snow work. And the last thing I would ever do is go through an RFP process to try to replace them or to try to squeeze them for some more money. I have way more things better to do in my life. I would never, ever do that. The company that comes out and cleans our furnace, we would never, unless they, burn the house down by mistake, we would never shop them.
Yeah.
Okay, so I think that's having that evergreen type relationship with you, that drives up valuation. So I think that's a really good thing. The best type of revenue you can have from a valuation perspective is subscription revenue. Repeat revenue that you don't have to resell all the time. And if you set it up right, that's exactly what residential work is.
Awesome. And we have another question. Will a sole proprietor business be less valuable than an LLC or S Corp?
No, not at all. But there's no liability protection with a sole proprietorship, so that would never be a recommended move. Nobody should have a sole proprietorship. Because all your personal assets are exposed.
Yeah. So you'd want to make sure that the LLC.
But there's no okay. So from a valuation perspective, there's no difference. Think about this. If you're the sole owner of an LLC, that's called a disregarded entity, and it's called that by the IRS because it functions exactly the same as a sole proprietorship. So, but there's liability protection with an LLC. That's why we want to have an LLC. But as far as the functionality and what a business is worth, there's no difference at all.
Very nice. Looks like that's the last question here, but that's also why we have Phil's email here. So if anybody has any questions, definitely reach out there. Phil, is that the best way for people to reach out?
Yeah, for sure. Yeah, like I said, I'm traveling a lot, so I can always handle email. And I love to hop on the phone. If you want to chat for 10 minutes or 20 minutes or whatever, I'll do that all day long. But email is probably the best way to get started.
Awesome. No, that's great stuff, Phil. And thanks again for hopping on here and sharing all this advice. I think it's such an important piece of the puzzle where, it's oftentimes not the first thing people think about. I think when you're building a company and just growing it over time, I think a lot of times you get more stuck in the day-to-day stuff, and maybe you kind of put aside different things like this in regard to just planning for the future. So it's really, really important stuff. And I think for those of you that had joined us today live, even just being that it's June 17th and busy time of year, I think it says a lot as well for just what you're looking to do for your companies. And but thanks again, Phil. Appreciate it.
Very welcome. Thank you.
Thank you, Phil. Thank you for everybody that joined. Bye.
Have a good one.